Welcome to the deep dive. Today, we're plunging into a company that really epitomizes the high-stakes, high-reward gamble of cutting-edge technology. IonQ, Inc., ticker symbol IONQ.
Right.
It's a company right at the heart of the quantum computing revolution. You often hear whispers about it being on the cusp of its very own ChatGPT moment.
That comparison comes up a lot.
But is it the future? Or is it maybe a speculative bet that's already, run too far? That's the tension we really want to explore today.
It's a great question, a really polarized case.
As of our analysis, that's September 17, 2025, IonQ's share price was sitting at $65.44.
Yep.
So our mission here is to cut through some of the hype and give you a fundamental understanding of IonQ, its business, the people running it, the financials, and where it fits in this really new, explosive market.
We'll try to give that clear-eyed view, look at the opportunities, sure, but also the very real risks.
Definitely. And before we dive in, just a quick note. This Deep Dive is brought to you by Stock Analytics AI. Please like and subscribe to our YouTube channel.
It helps us out a lot.
It does. And for just $4.99 a month, members get priority deep dives on specific tickers. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access.
And if you just want a one-off deep dive,
just drop us a super thanks. Easy as that.
Great.
All right, let's kick things off. Chapter 1, Business Analysis. To really get a handle on IonQ, we need to understand its core business model first. I mean, how does a quantum computing company actually make money right now?
Yeah, what's interesting, I think, is IonQ's multi-pronged approach. It seems strategically designed to capture value across the whole, quantum adoption life cycle.
Okay.
Their primary stream, and probably the most scalable one, is quantum computing as a service, or QMNOS.
Right.
They make their quantum computers available on the big cloud platforms, AWS Bracket, Microsoft Azure Quantum, and Google Cloud.
That's huge, being on all three.
It's a massive strategic advantage. It lowers the barrier to entry for developers, researchers, helps build that ecosystem.
So it's kind of like renting out time on these super powerful, almost futuristic processors. But they do more direct stuff too, right, for bigger clients?
Exactly. For more sophisticated customers, they offer direct hardware sales and dedicated access. That can mean significant upfront revenue, and it builds these deep, long-term partnerships. And critically, let's face it, there's a real scarcity of quantum expertise out there, so they also offer professional services and co-development.
Like consulting almost.
Pretty much. Creating custom algorithms for specific client problems, it embeds their tech really deeply into what those clients do.
Okay, so that leads us to their key products. What are they actually, building and selling here? What's the tech?
Well, their flagship product right now is the IonQ Forte. That's a trapped ion quantum computer, and it boasts 36 algorithmic qubits, or #AQ.
Algorithmic qubits, #AQ. Now, that's a specific metric IonQ uses. It's not just counting qubits, is it? Why is that distinction important?
It's absolutely critical. You nailed it. #AQ represents the useful computational power. It's not just the raw number. It factors in the quality of the qubits, their fidelity, how well they're connected.
So, a more realistic measure for running actual complex algorithms.
Precisely. Gives you a much better sense of what the machine can actually do. And beyond just the computing side, IonQ has moved pretty aggressively into quantum networking.
Through acquisitions, right?
Yeah, acquisitions like ID Quantique and Quibitek. This lets them offer things like quantum key distribution systems, QKD for ultra-secure communications, and also quantum random number generators, QRNGs, which are crucial for modern cryptography.
Okay, so pulling these pieces together, what does this tell us about their position in the market? What's their core value proposition?
Well, they've definitely established themselves as the pure play leader, I'd say, in commercializing trapped ion quantum computers. That's their niche.
And that cloud presence.
That unparalleled presence on all three major clouds gives them a huge first mover advantage in building out that developer community.
And the value proposition itself sounds transformative.
It is, potentially. The aim is to provide computational power that's fundamentally beyond what classical computers can do, solving previously unsolvable problems. Think materials, science, drug discovery, finance, logistics, even AI.
So for businesses, that translates into a potentially massive competitive edge.
That's the promise.
Okay, let's zoom out a bit then. Industry analysis. How big is this whole quantum sandbox IonQ is playing in?
Well, the market's still nascent, early days, but the forecasts are just explosive. Some suggest a total addressable market, or TAM, reaching maybe $65 billion by 2030
Wow.
and potentially generating something like $850 billion in economic value by 2040. We're talking compound annual growth rates, sine AGR, possibly exceeding 30%.
What's driving that kind of growth?
A few things. The convergence with AI is a big one. Also, a growing focus on finding practical, real-world applications, not just theoretical stuff. And the rise of quantum networking for secure communications adds another layer.
But as you said, they're focused on trapped ion. They're not alone in the quantum space, right? What's the competitive landscape look like?
Oh, it's intense.
Yes.
Really intense. You've got
Yeah.
the tech giants, Google, IBM, Microsoft. They're mostly focused on a different approach. Superconducting qubits?
And other pure plays.
Yep, companies like Rigetti, D-Wave, they're out there too. IonQ's key differentiator, their whole bet really is on that trapped ion modality.
Can you quickly break down the pros and cons, trapped ion versus superconducting?
Sure. So trapped ion, like IonQ uses, generally boasts higher fidelity qubits. They last longer before errors creep in. That's longer coherence times, and it's easier to connect any qubit to any other qubit. All-to-all connectivity.
That's good. Downsides.
The gate speeds, the actual computations, tend to be slower currently compared to superconducting, and scaling it up has its own complexities.
And superconducting.
Faster gates, definitely. And they can leverage some existing semiconductor manufacturing techniques, which is a plus. But shorter coherence times, lower fidelity generally, the qubits are usually fixed in place, and they need serious cryogenic cooling. Big, expensive refrigerators.
So different trade-offs. IonQ is betting accuracy and stability will win out for certain key applications.
That seems to be the core bet, yes.
Okay, that's a great tech overview. But like any powerful new tech, there are rules. What about the regulatory environment, especially with something this potentially disruptive?
That's a really important question, especially now. How are governments viewing this? Well, the U.S. government, through the Bureau of Industry and Security, the BIS, they implemented some pretty sweeping export controls back in September 2024.
Ah, okay. What do those controls do?
Basically, they restrict exporting quantum computers and key components to certain countries. And they also introduced these deemed export disclosure requirements, which can be complex.
And the impact of that? Is it just about stopping adversaries?
Well, that's the stated goal, preventing sensitive tech from falling into the wrong hands. But it also creates a pretty significant compliance burden for companies like IonQ.
Right.
And there's a risk it could fragment the global research ecosystem. Quantum innovation has really thrived on international collaboration historically. So these controls, they could potentially slow things down or make it harder to operate globally.
And even before you worry about exporting, just getting into this business,
Right.
the barriers to entry must be enormous.
Oh, absolutely. Among the highest barriers you'll find in any sector, I'd argue. First, the technological hurdles are just immense. Managing decoherence, keeping those quantum states stable, developing effective error correction. These are huge scientific challenges.
And the costs.
That's the other big one. Immense capital intensity. You need vast sums for R&D, for highly specialized equipment. And then there's the talent scarcity.
Finding the people.
Exactly. There's a global war for PhD-level quantum physicists and engineers. They're incredibly rare and highly sought after.
So given all those challenges, the tech hurdles, the cost, the talent, the regulations, what gives IonQ its competitive advantage? Where's their moat, so to speak?
Good question. Their moat seems built on several pillars. First, don't underestimate brand strength and recognition. Being named to the Time 100 most influential companies, getting recognition from Forbes, that helps build credibility.
True, but for a deep tech company, surely the tech itself.
Absolutely. And that leads to the potential for cost advantages, though maybe not in the traditional sense yet. The acquisition of Oxford Ionics is potentially huge here.
Why is that one so key?
Because Oxford Ionics is focused on building these ion traps, the heart of the computer, on standard semiconductor chips, using existing manufacturing processes.
Ah, so that could dramatically drive down the cost per qubit eventually, and allow for mass production.
That's the hope. It could be a genuine game changer for scalability and economics if they pull it off.
And network effects. Are those starting to play a role?
It's nascent, but yes. That cloud platform presence we talked about. As more developers start building specifically for their trapped ion architecture, it creates sort of soft switching costs. People get familiar with their tools. And longer term, their vision includes interconnected multi-core quantum systems. If they achieve that, you'd see a true network effect emerge.
And finally, there's sort of unique assets.
Yeah.
the core tech and IP.
Exactly. It really boils down to their trapped ion technology itself. Using these naturally identical ions as qubits means inherently higher fidelity, longer coherence times. They're betting that for many valuable problems, accuracy and stability are more critical than just raw speed.
And the patents.
Complementing the tech is a formidable intellectual property portfolio. They claim over 1,000 patents and applications. That's built through foundational research, but also very aggressive M&A across the entire quantum stack. It's a significant barrier.
Okay, let's shift gears. Chapter 2, management evaluation. Because even with the most amazing tech, leadership is crucial. What's the assessment of the team steering the IonQ ship?
Well, the leadership team looks like a pretty strong blend of technical depth and business experience. That seems appropriate for a company trying to make that transition from, a research-heavy startup to a real commercial enterprise.
Who are the key players?
You've got Niccolo de Masi as CEO. He took over in February 2025. He brings a lot of experience in scaling public tech companies and doing M&A. That seems relevant given their strategy.
And the previous CEO, Peter Chapman?
Yeah, Peter Chapman is now executive chair. He was apparently instrumental in setting up their manufacturing and those crucial cloud partnerships. Plus, he has experience from Amazon Prime, which is interesting.
Mm-hmm. And the finance side?
The new CFO and COO is Inder M. Singh. He comes with a background from ARM Limited and Comcast. That experience, especially from ARM, seems really relevant for their push towards a semiconductor-based roadmap with the Oxford Ionics tech.
So, a team with relevant experience, how have they executed so far?
Well, they successfully navigated taking the company public via a SPAC merger, which isn't always smooth. That raised a lot of capital. And they've executed this string of pretty complex international acquisitions.
Okay. And how are they in terms of transparency with investors, with the market?
They seem to maintain a pretty high degree of transparency. Regular earnings calls, they hold an annual analyst day where they lay out the strategy.
And ethical reputation. Anything noteworthy there?
Seems strong. They've actually won awards for being a top workplace, which usually points to a decent internal culture.
All right, let's talk about capital allocation. This is critical for a company burning cash. How are they spending the money they've raised?
Their strategy here is clearly dominated by these aggressive strategic acquisitions. That's the main theme.
Right, using their stock as currency mostly.
Primarily, yes. Using their highly valued stock to buy up capabilities, aiming for vertical integration, and trying to accelerate their roadmap. We mentioned Oxford Ionics. That was a huge deal, over $1 billion on paper. ID Quantique and Corbitek for that quantum networking and security piece. LightSync for something called photonic interconnects. Basically, using light to move data faster between quantum components.
Okay.
And they've also announced plans to acquire Vector Atomic, which would move them into quantum sensing.
So it really looks like they're trying to build this integrated ecosystem and control the whole stack, almost like Apple does with hardware and software.
That seems to be the playbook, yeah. But this aggressive use of stock and the high valuation it implies brings us back to something insider activity.
Oh, yes, the selling.
While the company's using its stock like currency for these big bets, it's a critical observation that over the last 6 to 12 months, top executives have been consistently selling large amounts of their personal stock holdings.
That's a pretty stark contrast, isn't it?
Yeah.
Corporate strategy, using stock, personal decision, selling stock. How do you interpret that? Is it just normal post-SPAC lockup selling or something more?
It's a really important question. Look, some selling is normal. People need liquidity. They want to diversify, especially after a SPAC lockup expires and the stock has run up a lot. That's fair.
But the scale here.
The sheer volume and the consistency of the selling, particularly over the last year, it's definitely a data point investors need to consider. It does suggest that, from the executive's personal financial perspective, the current high valuation looks like a good time to take some significant chips off the table.
Okay. And just to confirm, no share buybacks or dividends?
None whatsoever.
Yeah.
As a high-growth, capital-intensive company, all their cash flow is going right back into R&D and these strategic acquisitions. That's standard and frankly appropriate for their stage.
Makes sense. So what about metrics like return on invested capital, ROIC? Is that even relevant here?
Honestly, not really. Not yet. It's deeply negative right now. Looking at current ROIC doesn't tell you much.
So the investment thesis isn't about today's returns.
Exactly. It's entirely about the potential future ROIC. If quantum computing reaches commercial viability, if IonQ captures a big slice, if they reach scale.
A lot of ifs.
A huge number of ifs. The core question for you as an investor is whether you believe that potential future return will ultimately justify the immense risk and the enormous amount of capital being poured in today.
All right, let's dive into the numbers themselves. Chapter 3, financial analysis.
Oh.
What does the balance sheet, the income statement, what do they tell us about IonQ's current financial health?
Okay, so IonQ really presents that classic profile, almost textbook, of a disruptive tech company in hypergrowth mode, meaning explosive revenue growth, sure, but it's funded by significant amounts of external capital. And that leads to substantial net losses because they are investing incredibly heavily for that long-term market leadership.
And the market cap reflects that ambition.
Oh, yeah. As of our analysis date, the market capitalization was sitting at a pretty staggering $18.98 billion.
Wow. Nearly $19 billion. Okay, let's break that down. Revenue growth trends. You
Yeah.
said explosive?
Spectacular, really. Although, you have to remember, it's coming off a very small base. Full year 2024, they reported $43.1 million in revenue. That was a 95% increase year over year.
Okay, strong growth. And more recently.
Q2 2025 revenue came in at $20.7 million. That's up 81.6% compared to Q2 of the previous year.
And what are they guiding for the full year 2025?
Management's guidance is for revenue between $82 million and $100 million. So at the midpoint, that's about 111% annual growth. Still very rapid top-line expansion.
Okay, very impressive top-line growth.
Well-
But the bottom line, what about profit margins?
Yeah, that's the other side of the coin. Deeply negative across the board. In Q2 2025, they reported an operating loss of $160.6 million.
Just in the quarter.
Just in Q2. And the net loss was $177.5 million.
Where's all that money going?
Primarily massive investments, especially in R&D. Research and development expenses hit $103.4 million in Q2 2025 alone. That's up 231% year over year. Just reflects that aggressive push to stay ahead in the quantum race.
So presumably free cash flow generation is also negative.
Consistently and significantly negative, yes. And the cash burn is actually accelerating as these investments ramp up. Again, typical for a company at this stage, but something to watch closely.
Okay, let's talk financial stability. You mentioned consistently negative earnings.
Right, which is entirely expected for a pre-commercial deep tech venture like this. The real focus for stability isn't earnings right now, it's their revenue growth trajectory, and crucially, their ability to fund operations until they can reach profitability.
And how are they funding it? What about debt?
This is a major strength, actually. They have an exceptionally strong balance sheet with little to no long-term debt.
Really?
Yeah, they've funded their growth almost entirely through equity. Selling stock, like in the SPAC deal and subsequent offerings, that gives them maximum financial flexibility, no big debt payments hanging over them.
That is a significant plus.
Yeah.
So their cash position, their liquidity must be strong, though.
Very robust. As of the end of June 2025, they held about $656.8 million in cash and investments. But then, in July 2025, they did another big equity financing deal, raising $1.6 billion. So that brought their pro forma cash balance up to approximately $1.6 billion.
Wow, $1.6 billion in cash. That sounds like a lot. How long does that runway last them?
Well, if you just take their Q2 2025 operating expenses as a rough guide, that $1.6 billion provides a financial runway of about 9 quarters, so just over 2 years.
Okay, but
yeah, expenses are likely to keep rising. They're growing. They're making acquisitions. So managing that cash burn carefully remains absolutely critical. They might need to raise more capital down the line.
got it. It's still no dividends, obviously.
No, definitely not.
Okay, so maybe you could quickly summarize those key Q2 2025 metrics.
Sure, roughly. Market cap around $18.98 billion. Trailing 12-month revenue about $52 million. Q2 revenue growth 81.6% year over year. Net loss for Q2 was $177.5 million. Pro forma cash around $1.6 billion. Minimal debt and shares outstanding around 298 million.
Okay, thanks. That brings us to the really tough part, valuation analysis. How on earth do you value a company like this?
Yeah, this is probably one of the most challenging exercises in finance right now, because IonQ's worth is almost entirely based on potential future performance, not anything happening today.
So traditional metrics are out. Price to earnings.
Completely meaningless. PE doesn't work with negative earnings. And while you can calculate a price-to-sales ratio, it's over 300 times trailing sales, which just confirms what we already know. The market has priced in absolutely enormous future growth and, frankly, a lot of speculation.
So if trailing metrics don't work, We have to look at intrinsic value, something like a discounted cash flow DCF model.
Exactly. A DCF is really the most appropriate tool, conceptually at least, but it's fraught with difficulty here.
Why?
Because you have to forecast future cash flows for a company in a nascent industry with huge technological uncertainty. Those forecasts are highly speculative, and then you need to determine a discount rate.
Which would have to be very high, right, given the risk.
Extremely high. You're probably looking at 15–20%, maybe even higher, to reflect the speculative nature, the high growth expectations, the pre-profit status.
And the output of that DCF would be incredibly sensitive to those inputs.
Hugely sensitive. You tweak the long-term growth rate assumption or the discount rate even slightly, and the resulting valuation can swing wildly. You could build a DCF model where aggressive, sustained growth justifies or even exceeds the current market price. Or if you assume slower adoption, more competition, higher risk, the model could spit out a valuation significantly lower than where it's trading today.
So the key assumptions you make in the model, they determine the outcome entirely.
Pretty much. That long-term growth rate may be starting at 50–100% initially, then tapering off, and that very high discount rate are the absolute key drivers. At the end of the day, IonQ's financial profile is basically that of a venture capital investment being offered on the public markets.
Meaning the outcomes are kind of binary?
Feels that way. Either they execute incredibly well, the market develops, they become a dominant player, and the stock could potentially be worth many, many times its current price. Or they stumble, the tech doesn't scale commercially, competitors win out, and the value could drop substantially, maybe even towards zero. It's that kind of bet.
Okay, let's turn the page then. Chapter 4. Market sentiment. Beyond the pure financials, what's the general vibe around IonQ? What are analysts saying? What's the street feel?
Market sentiment here is, well, it's a fascinating study in contrast. You see extreme bullishness, particularly from Wall Street analysts, but that's balanced by some significant skepticism, which you see reflected in the short interest.
Let's start with the analysts. What's the consensus?
The consensus rating is an overwhelming buy. Out of 23 analysts covering the talk, there were 20 buy ratings and only 3 holds. No sells.
Wow. Any recent examples? Price target changes?
Yeah, especially after the recent Analyst Day, we saw a flurry of target raises. Needham went to $80, Benchmark to $75, B. Riley also $75, Rosenblatt $70, Craig Hallam $65, Cantor Fitzgerald $60.
So generally very positive outlooks from the sell side. What are they citing?
Usually the ambitious tech roadmap they laid out, the aggressive M&A strategy to build that integrated ecosystem, and yeah, that strong financial position, the cash balance.
And does the general media coverage echo that positive tone?
Very much so, yeah. Recent news has been dominated by these positive strategic announcements. Completing the Oxford Ionics acquisition was big news. The planned acquisition of Vector Atomic for quantum sensing, launching IonQ Federal to target government contracts. It's mostly positive headlines.
Okay, so it sounds like everyone's bullish.
Mm-hmm.
Or is there another story bubbling beneath the surface? What do the market indicators tell us?
Here's where it gets really interesting. Despite that overwhelmingly bullish narrative from analysts and the media, there is a significant group of bearish investors out there.
How do we see that?
The short interest. As of late August 2025, IonQ's short interest stood at approximately 44.3 million shares. That represents 15.27% of the public float.
Whoa, over 15% short interest. That's really high.
Right.
What does that signal to you?
It signals that a substantial amount of capital, serious money, is betting against the stock, betting on the price going down.
And their thesis would be?
Likely focused on everything we've discussed on the risk side. The massive valuation compared to current revenues, the lack of profitability, the high cash burn rate, the immense execution risk in scaling the technology, all those factors.
Yep.
It creates this classic battleground stock scenario, bulls versus bears.
Okay, so a lot of skepticism priced in via shorts. But how is the stock actually trading right now? Technicals.
Technically, the stock has been very strong recently. Its current share price, that's $65.44, is substantially above its 50-day moving average, which is around $43.30. That shows strong short to medium-term momentum.
In longer term?
The longer-term trend is also bullish, technically speaking. The price is significantly above its 200-day moving average, which was closer to $36.39. So strong uptrend, despite the high short interest.
Fascinating. So the market seems caught in this tug of war between the powerful narrative of revolutionary technology and future potential, and these very real underlying financial and execution risks highlighted by the shorts. Let's explore who actually owns the stock. Chapter 5. Ownership structure. Who's holding IonQ?
Yeah, the ownership profile shows a really interesting kind of unusual dynamic. Institutional investors are the largest single block. They hold approximately 45% of the outstanding shares.
Any big names in there?
Oh, yeah. Major players like the Vanguard Group holds about 8.3%. Morgan Stanley has a big position, around 6.8%. And interestingly, they dramatically increased their position in Q2 2025. BlackRock is also significant, holding about 6.1%.
Okay, so some of the biggest institutional money managers are definitely in. They've bought into the story.
Mostly, yes. It shows long-term conviction from some major players. However, it's also worth noting that D.E. Shaw & Co., which is a very prominent, quantitatively driven hedge fund, significantly reduced its position recently, so not universal institutional agreement.
Interesting. Now, what about the people who actually run the company? The insiders. We touched on their selling.
Right. And it's a stark contrast to that institutional accumulation we just talked about. Insider activity tells a very different story. First off, insider ownership overall is relatively low, only around 2%.
Okay.
But more importantly, the recent transaction history is just overwhelmingly characterized by selling. As we discussed over the past 6 to 12 months, top executives have consistently sold large amounts of their personal stock holdings.
Can you give some specifics on that selling?
Yeah, I mean, in the last 6 months alone, insiders apparently sold shares 29 different times with absolutely zero open market purchases. Key sellers include the former CEO Peter Chapman, the current CEO Niccolo de Masi, the former CFO Thomas Kramer.
Yeah.
Collectively, they've sold hundreds of millions of dollars worth of stock. For instance, just recently, on September 11th, CEO Niccolo de Masi sold over 16,000 shares.
Wow. So it really reinforces that point. Whatever the corporate strategy, from their personal perspective, the current high valuation looks like a very attractive time to cash in significant amounts.
It certainly suggests that, yes, actions often speak louder than words.
Okay, so we have institutions holding about 45%, insiders only 2%, and selling. Who holds the rest?
A very large portion, approximately 52.7%, is classified as held by the general public. That's basically a proxy for retail investors.
Over half the stock held by retail. That's quite high.
It is high, and this high level of retail involvement probably helps explain a few things about the stock's behavior. Its high trading volumes, its sensitivity to news headlines and social media sentiment, and its overall volatility.
So you end up with this barbell of conviction almost. You've got large long-term institutions accumulating on one side. You've got insiders consistently reducing their personal exposure on the other. And then this huge retail base likely driving a lot of the momentum and volatility in the middle.
That's a great way to put it. A lot of very different forces pulling on the stock price.
All right, let's move into the formal risk assessment. Chapter 6, Risk Assessment. Obviously, investing in a pioneering company like IonQ means you absolutely have to have a clear-eyed view of the substantial risks involved. Maybe framing this with a SWOT analysis. Strengths, weaknesses, opportunities, threats would be helpful. Let's start with the internal positives. Strengths.
Okay, yeah. IonQ's strengths are pretty clear and quite formidable. First and foremost is their leading-edge trapped ion technology. That potential for high qubit fidelity and longer coherence times is a core advantage. Second, that defensible intellectual property portfolio we mentioned, over 1,000 patents. That's a crucial moat in deep tech.
Right.
Third, their first mover advantage on all the major cloud platforms. That gives them unparalleled access to potential users and developers right now. And fourth, that fortress balance sheet with roughly $1.6 billion in cash and minimal debt. That gives them a long runway and strategic flexibility.
Those are definitely powerful internal capabilities. But what about the internal flip side? The weaknesses.
Yeah, the weaknesses are equally significant. Top of the list is the chronic unprofitability, deeply negative net losses, and they're still growing as investment ramps up.
Tied to that.
Is the high cash burn rate. That implies the financial runway, while long, is finite. Future capital raises seem likely, which could dilute existing shareholders.
Okay. What else?
A huge one is the unproven scalability at commercial levels. Going from dozens of algorithmic qubits today to the thousands or even millions needed for truly world-changing applications, that leap poses immense technical and execution risk. It's not guaranteed.
And the point we keep coming back to.
And yes, that consistent insider selling. It just raises persistent questions about the management team's long-term conviction in the company's current valuation, even if they believe in the technology itself.
Okay, weaknesses acknowledged. Let's flip outside the company now. What external opportunities could really propel IonQ forward?
Well, the biggest one is simply the massive total addressable market for quantum computing. If the forecasts are even remotely correct, we're talking hundreds of billions of dollars in potential market size. Capturing even a fraction of that would be huge.
What else?
Significant government investment and partnerships worldwide. Governments see quantum as strategically vital, and that funding can help de-risk R&D. And don't forget the powerful AI tailwinds.
How does AI fit in?
Next-generation AI models, especially foundation models, are demanding just immense computational power. Quantum computers, if they mature, are uniquely positioned to potentially meet that demand for certain types of AI problems, creating a huge synergistic opportunity.
Okay, massive opportunities, but also external threats. What challenges outside their control could derail IonQ?
Number one is just intense competition. We mentioned Google, IBM, Microsoft. These are trillion-dollar companies investing billions in their own quantum efforts, mostly using alternative technologies like superconducting qubits. They have vast resources.
And the risk that IonQ's tech path isn't the winner.
Exactly. There's the constant threat of technological obsolescence. What if there's a sudden breakthrough in superconducting qubits or photonics or neutral atoms that makes trapped ion less competitive or even irrelevant for key applications? That's a real risk in such a dynamic field.
And beyond the specific quantum world, broader risks.
Definitely. As a long-duration growth company essentially valued on future potential decades out, IonQ is particularly vulnerable to macroeconomic factors.
Like interest rates.
Precisely. A high interest rate environment directly impacts its valuation through that discount rate we discussed. Higher rates generally mean lower present values for future cash flows. Persistently high inflation could also increase their costs and accelerate that cash burn.
And political risks. We mentioned the export controls.
That's a big one. Those U.S. government export controls implemented in late 2024 pose a significant geopolitical threat. While the intent is understandable, they risk fragmenting the global research ecosystem and talent pool. That could slow down innovation across the board and directly impact IonQ's ability to collaborate, hire, and execute its global roadmap. It adds another layer of uncertainty.
Okay, we've covered a lot of ground. Let's bring it all together now in Chapter 7. Conclusion. Synthesizing all these findings, what's the big picture here for IonQ and for potential investors?
Well, the analysis of IonQ, as we've seen, really presents this deeply polarized investment case. It truly embodies that quintessential high-risk, high-reward profile, a company operating right at the bleeding edge of technological innovation.
So maybe summarize the bull case first. Why would someone invest?
The argument for IonQ, the bull case, rests on several pillars. Their clear leadership position in trapped ion technology, which many believe has fundamental advantages for certain applications. Their vast and growing IP portfolio. Their aggressive M&A strategy to build that integrated stack, that first mover advantage on all the major cloud platforms, their very strong balance sheet giving them runway, and a clear, albeit ambitious, technical roadmap.
So the bulls see them as
arguably the best-positioned pure-play company to capture a significant share of what could become a multi-hundred-billion-dollar market, they're betting IonQ becomes a foundational platform for the quantum era.
okay, that sounds incredibly compelling, a potential multi-bagger if it plays out. But the bear case, what's the counter-argument?
The counter-argument is firmly grounded in today's realities. First, that nearly $19 billion valuation for a company projecting maybe $100 million in revenue for 2025, with absolutely no clear line of sight to profitability yet. Second, the fact that they're burning hundreds of millions of dollars annually. Third, the monumental scientific and engineering hurdles still ahead to scale this technology effectively. Fourth, that intense competition from incredibly well-funded tech giants pursuing different paths.
The insider selling again?
And yes, perhaps most concerning for some bears, that persistent heavy selling of stock by the company's own top executives. You add the significant geopolitical risks from those export controls, and the bear case essentially argues the current valuation is detached from fundamentals and represents a speculative bubble built on hope.
So tying this back to valuation one last time for the valuation summary.
Traditional metrics, as we said, are useless. A DCF model is the theoretical tool, but it's so highly sensitive to assumptions about growth, adoption, and risk that it can produce almost any value you want, depending on how optimistic or pessimistic you are.
So aggressive assumptions might justify today's price.
Scenarios with really aggressive, flawless execution and rapid market adoption could theoretically justify the current valuation or even higher. But more conservative, perhaps more realistic assumptions would yield a significantly lower intrinsic value estimate.
So boiling it all down, what's your concluding outlook for our listeners considering IonQ at around $65 a share?
Comparing IonQ's current share price of $65.44 to its fundamental reality, its current revenues, losses, cash burn, and the immense uncertainties ahead in investment today, is absolutely not a traditional value investment. It's not buying a dollar for 50 cents based on current earnings.
It's something else entirely.
It is. It's fundamentally a venture capital style bet being offered in the public markets, a bet on a future that is very, very far from certain.
The potential upside is obviously immense if they succeed.
Absolutely. If quantum computing delivers on its revolutionary promise, and if IonQ becomes a key enabling platform for that era, its value could eventually be an order of magnitude, maybe several orders of magnitude, higher than it is today.
But the risks?
But the technological risks, the financial risks, the competitive risks, the geopolitical risks, they are equally substantial. And the possibility of significant or even total capital loss cannot and should not be dismissed. This is a highly speculative investment.
So who is it suited for?
It's best suited, I think, for investors with a very, very high tolerance for risk and volatility. Investors with a multi-decade time horizon, who understand the science to some degree and who are comfortable with the potentially binary nature of the outcome. Win big or lose big.
What a deep dive. Wow. We've really unpacked IonQ today, a company truly operating at the frontier of quantum computing.
Yep.
We've seen the incredible potential, the smart strategic moves they're making, but also, the significant, almost binary risks involved in betting on a future that's still very much being written.
It really raises an important question, I think, for you, the listener. In this world of incredibly rapid technological change, how do you balance that immense potential of a truly revolutionary idea with the very tangible present-day risks of an unproven future? Is that ChatGPT moment really just around the corner for quantum? Or is it still perhaps a distant horizon, something to ponder?
Definitely food for thought. We hope this deep dive into IonQ has given you a much clearer perspective on the company and the stakes involved. If this has sparked your curiosity and you want more detailed analyses like this,
Please do remember to like and subscribe.
yes, like and subscribe to Stock Analytics AI on YouTube, or become a member for just €4.99 a month to get priority access to our deep dives, including our upcoming coverage of the entire S&P 500. And remember, a super thanks gets you a one-off custom analysis.
Thanks for tuning in.
And finally, our important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Thanks for joining us on the Deep Dive.